Will the recession affect real estate? That's a question on many homeowners and real estate investors' minds. Rising inflation and interest rates are impacting everything from food and energy, the stock market, and employment. But will it affect real estate? Well, let's take a look. You ready? Let's go. All right, so by the time we're done, you're going to know how the recession could affect real estate and what there is for homeowners and real estate investors to do about it. So as you likely know, the housing market has experienced over 10 years of exceptional growth, where the median home price jumped an incredible 117% as of March 2022. So this rate of growth has only been outpaced by the home price growth in the decade before the Great Recession of 2007 to 2009, where home values rose 121%. Home prices continue to rise, having reached an all-time high of $407,600 in May. Despite signs of slowing demand thanks to rising mortgage rates, it seems nothing is stopping this red-hot market from soaring. But a recession might. Although we're not technically in a recession as of this recording, several experts believe we are already in one, and the rest believe a recession is inevitable. And the impact of a recession, it can be felt across the entire economy, everywhere from employment to spending to stock market volatility, as we're all witnessing at the moment. With regard to the real estate market, we are seeing a slowing right now. But we've yet to see any sort of correction in the national median sales price. We're certainly seeing a pullback in the stock market, but historically speaking, stock market and real estate crashes or even corrections aren't guaranteed to happen during a recession. In fact, falling prices are less common than you may think. Aside from the Great Recession and the recession of 1990, home prices have remained steady or even risen during the last 5 recessions. High mortgage rates can deter people from buying, but as the recessions of the 80s and the 90s showed us, when rates reached levels as high as 18%, demand nor prices didn't suffer much at all. It's demand and affordability that has more of an impact on the real estate market than anything else. In 1980, the median income was close to 45% of the median home price. And today, that number sits right around 30%. Suggesting real estate is less affordable today. And that's the best number for us to pay attention to if we're going to make any predictions about the housing market. Now, if I were a gambling man, and I am to some degree, I'd say a significant deceleration in the housing market is very likely, despite the surge in wages that we saw in 2021. You see, with wage growth still close to double the pre-pandemic rate, wages are still not keeping pace with inflation, home prices, or rent rates. So it's pretty easy to see how the rising interest rates will cut deeply into the average person's affordability to purchase real estate. The trend is already showing that the demand for housing is cooling, of which, should it continue, we should see prices pull back to more affordable levels, but still, maybe not. And here's why. You see, although the demand is decelerating, it hasn't yet been enough to reverse the pricing. The number of closed sales, that's dipped, but the prices have yet to. And certainly we're seeing price reductions of homes that are for sale, but we're not yet seeing a reduction in the prices of homes that have actually sold. That's a big distinction, one that could mislead people about the current health of the real estate market if they overlook that detail. The decelerating demand, this is getting most of the headlines these days. But it's an incomplete picture unless the supply is also considered. With more than a decade of dramatically reduced home builds, coupled by 4 straight months of declining builder confidence, the limited housing supply for sale, that could keep the market propped up for some time, even if a recession were to last multiple years. That's how out of balance the supply and demand dynamic is. With all that said though, this time could be different. And I'll tell you why in just a second. But if you like making money in real estate, let me know by hitting the like button. And if you take your real estate investing seriously, subscribe to the channel and ring that little bell that you see there, that little bell icon, to be notified of new videos as they are released. So this time could be different because the Federal Reserve usually lowers interest rates during a recession to help make the cost of borrowing more affordable and spur more economic activity, particularly within the housing market. But that's not an option today, considering the Fed's move to aggressively raise rates to combat skyrocketing inflation after the pandemic-related recession. The continued increase in energy, gas, and food costs is weighing and will continue to weigh on consumers, making housing less and less affordable than it already is for most people. Further, a recession, which is usually marked by high unemployment, could cause people to list their homes as they lose their jobs or relocate for new ones. This could also lead to higher rates of foreclosure, which would add to inventory levels, of which should translate to a reversal in prices. But despite the recent murmurs of the foreclosure tsunami that's headed our way, it's not even wetting our toes at the moment compared to pre-pandemic rates of foreclosure. The experts, the media, the Twitter warriors are all calling for a housing crash, but it's unlikely that we'll see a massive drop in values like we did during the Great Recession. Rather, certain markets that are overpriced for the median income of the area are more likely to see prices slump for a while, and others are likely to see demand and price growth continue, maybe just at slower rates. So what are home buyers and real estate investors to do amid an imminent recession? Well, it depends. Are you a long-time investor? Or are you a speculator trying to time the market? If you're a speculator, it's realistic to think there will be a window of opportunity in the near future to pick up cheaper property. So selling now to buy back in later, whether 6 months or 18 months from now, could prove profitable. But will it be profitable enough for the effort involved and the risk of timing it wrong? Investors and homeowners that are worried about losing value in their real estate should find comfort in just taking a deep breath and shifting to a long-term focus. Despite corrections and crashes of the past, real estate values have always rebounded, not to mention exceeding previous highs. As of right this very moment, we're at an all-time high. So what that means is, if you purchased real estate a month ago or before, you're in the black, regardless of mortgage rates, inflation, or a pending recession. Whatever pullback we do see in real estate prices will likely be minor and short-lived, due to the gross lack of inventory. In fact, if you have a long-term vision for real estate based on the supply and demand dynamic in the market, where we have many more people than we have houses, and it will be that way despite a recession for a very long time, there's little logic to justify pulling back on your own investing activity, as it's very likely that real estate investors swim easily through this economic turmoil, while those sitting on the sidelines playing it safe trying to wait this thing out drown. If you'd like to dive deeper into what it takes to find off-market real estate deals and purchase them without the need of expensive bank financing, you'll probably like what I've put up for you over at reiace.com. Take a look, and if you like what you see, just answer a few questions about you and your ambitions, and then pick a time for us to hop on the phone. We'll brainstorm some ideas about you winning in real estate during a recession, regardless of how long it may last. So what'd you find most valuable? Share with me below, I want to know. And who else do you know that might need to see this? When their name comes to mind, please share it with them. That's all for now. Thanks for watching. I'll see you next time.